Looking back here, there's no inefficiency until we get right there on this candle. That's the only inefficiency on that time frame. Okay, this being the 5-minute chart on the right. Because if you keep going up, there's really nothing in here to speak of in terms of inefficiencies. Now, you do have all of these consecutive up-close candles, which makes that a what? An ICT bearish order block. These up-close candles, if you take the body or the opening price of that lowest one and draw that out, looking at this, we talked about the very fair value gap right there. It's a premium array. What makes it a premium array? Well, the fact that we returned back up into it here, what was the range prior to that? What was the dealing range? This high. Okay, so that's the high end of the dealing range, and the low of the dealing range prior to that return to that fair value gap right there is that low right here. So that's your dealing range. So what the algorithm does, it takes that range. How does it determine that range, ICT? If this is really an algorithm, how do you determine what a dealing range is? Well, first of all, you have to determine what your directional bias is, because if you don't have a directional bias, you don't have a dealing range. You're just using randomness. I see this old low over here on the daily chart. That's my personal interest. I'm accepting the fact that I can be wrong, because this week has already demolished and went way beyond my objectives for the week. In fact, everything I was looking for this week, it happened just on Monday alone. So it was a very overzealous Monday. And that's characteristic of what? We had CPI and PPI, and those are huge market drivers. And if they're occurring later in the week, Wednesday, midweek, if you're expecting a big move, if it doesn't happen by Wednesday, then you anticipate the latter part of the week to be big candles. But because we had CPI and PPI, those are introducing many times what? Large range candles, lots of volatility, big movement. If there's going to be an FOMC event, in the week, that means usually the beginning of the week will probably be really nice. And then you can get your nice setups there. So anyway, the dealing range high here, what makes this a dealing range high? Well, we're moving from this low all the way up here into this inefficient. I'm going to have to drag this down a little bit, sorry. All these inefficiencies here, this one, we're trading up into that. This candle's high, 17,724 even. And what does that say? 17,724 and a half. That's all it takes, folks. It has to clear a high to do what? To engage opposing liquidity. When you have that, if you're bearish, you want to see does it displace lower. Displacement is movement one-sided and heavy, in this case because we're bearish. If it was moving higher, it would be steady and consistently moving higher. This bump above that high, once it starts making lower lows, we're aiming for this to be swept. It does. Now, to get in sync post 8:30 news release, we go back through that range. That high is the highest high of the dealing range. That low is the low of the dealing range. Why? Because we've taken the buy side here and we've taken sell side. So it has engaged what? Both sides of the market, short term. What time frame? The 5-minute. Why 5-minute ICT? If you're looking at high impact news driver days, at the time of the release, minimum 15 minutes, you can't be underneath a 5-minute chart. Otherwise, you're going to get beat up with the spottiness and price action. 30 minutes for good measure. It's designed to run wide, wider than you're probably going to expect it to seek liquidity. But when we have both sides of the marketplace swept, we have it here, there, and that low's taken. So what has the market done? First, what has it done? It has bumped the buy side. Does it displace? Yes. Is it able to take out the low? Yes. So what is this? This is many things here. You're going to discover how all my concepts overlap. And the strongest setups are going to be the ones that you can see have multiple reasons why it should do one thing and not the other. Meaning, this low being taken out, remember the bias is bearish. I don't need it to trade down to this daily low. I just need it to be able to move in that direction. Now think, if my bias is bearish, do I sell short on a break below that old low down here? No. I want to see the market come right back up into the range. Why? What is that doing? Well, let's see. That's model 2022, high, low, retrace. Here's 50%. Is the fair value gap above the 50% or at it? Well, here it is. That means it's a premium array. Okay, so here's the 62% retracement level, and here's the 70.5. Why 70.5? Because that's the sweet spot. You can use the 79% retracement level, but if you're demanding that or just below it as your entry, you're going to miss a whole lot of sweet trades. So you want to know what that 79% retracement level is, because then you want to look just above that. Okay, that's the 79% retracement level. So this is the optimal trade entry area here. 70.5, that's my high water mark for shorts. If I can squeeze something in at that price level, I'm going to try to do it. but 62% retracement level is about as good as I need it to be. And I'm going to have most of my limit orders if I'm trying to sell short in a short that is optimal trade entry and not bias is there and it's a lot of things going for it. I could enter right at 60% retracement level and then I'll layer additional limit orders. They may not fill. If the market starts to move in my favor, I'll just close the existing limit orders. But ranges and understanding the range and the liquidity and why the market should reach to a specific level or in a direction, that's where 99% of your focus should be. Always. All of your focus and time and analysis should be spent on that weekly, daily chart. Why should it behave a certain way on those two time frames? Keep referring back to it. Is it still showing you things that would warrant you trusting your initial analysis? Is it really trying to still reach for that objective that you outlined on the weekly chart? Is it really trying to reach for that objective that you outlined on your daily chart? And as long as those two things remain true, you should never fear holding on to the trade. So the fair value gap is above the 50%. So that means what? That's a premium array. And then the trade can be taken where shorting here or trading into the 62, the 79% retracement level inside that area. And I've already told you the 70.5 level, that's that sweet spot. Okay. So I'm trying to get that price if I'm using optimal trade entry or just below it. And I'm layering limit orders in if I'm going short at the 62% retracement level to the 70.5. I am not trying to get the 70.5 level because many times if you go back and look at your old data, you'll see that it just touches 70.5. And will that fill you? No, because you need the spread. So the dealing range is, this is how you define it now. Listen, this is for your notes. A dealing range is a high that has engaged buy side and a low that has engaged sell side. So now you've expanded outside the realm of the nearby close proximity liquidity. A dealing range is not a dealing range unless it takes both sides of liquidity, period. End of story. And it must be on the time frame you're looking for in terms of the analysis. So hello, have you noticed that we're talking about that 5-minute chart? The dealing range high and the dealing range low, we have to then see what? Where's the market going? What's it reaching for? You have to have something in terms of a longer